Softening U.S. jobs data, record-breaking earnings, and a violent shakeout in AI chip stocks are colliding to redraw the equity map right now. You are watching vTalkInsight, Equity Pulse Daily for July 3rd, 2026. Today we will connect the macro backdrop, the rotation beneath the surface of U.S. equities, and the latest company signals from Tesla, Meta, Apple, SK Hynix, and more, so that you can see where leadership is emerging and where the fault lines are opening. The latest U.S. labor data point to a cooling jobs market, not an outright break. June non-farm payrolls came in at just 57,000 versus estimates around 130,000, and prior months were revised down, pulling the three-month average to roughly 111,000. That is a clear deceleration, but still above estimates of labor force growth, which suggests slower momentum rather than imminent weakness. Beneath the headline, the mix is more troubling. The unemployment rate actually fell to about 4.2%, close to the Fed's estimate of a natural rate, but that improvement was driven by a drop in labor force participation from 61.8 to 61.5% and a reported loss of roughly 720,000 people from the labor force. That combination of weaker hiring and fewer workers raises questions about the underlying health and structure of the workforce. On the inflation side, the picture is mixed, but not alarming for equities. Wage growth is failing to keep pace with prices, and there are no signs of a wage price spiral or profit-led inflation, which reduces pressure for further aggressive Fed hikes. However, a stubborn component of inflation, roughly half a percentage point, remains embedded in services and has proven hard to squeeze out even as temporary drivers like energy fade. Taken together, this leaves the Federal Reserve with room to stay patient but not relaxed. Real yields are already high, with 10-year inflation-protected securities around 2.26%, so current market pricing is doing part of the tightening for the Fed, and many expect at most one additional hike, if any. Some forecasters now project policy on hold for several years, while rate cut expectations in markets have slid from October toward December after the mixed jobs data. The complication is that the Fed has largely stepped back from strong forward guidance, focusing its commentary on inflation, so each labor and inflation print has more potential to swing rates and, by extension, equity risk premia. For now, growth is still being supported by U.S. consumers who are maintaining spending despite higher prices by running down savings. That supports the soft landing narrative near term but leaves household balance sheets more exposed to shocks later on. Offsetting that, debt-to-wealth ratios remain low in major economies, with the U.S. below 30% and Europe around 20%, so public debt levels are not seen as an immediate market risk. In the equity context, this macro mix points to a slower but still growing economy, where earnings can hold up but where surprises in wages or participation could quickly change the narrative. Against that macro backdrop, corporate earnings are coming in far stronger than many expected. U.S. earnings growth is tracking close to 20%, and profit margins remain resilient despite inflation running above the Fed's target, which tells us that many companies are still able to pass higher costs onto customers. There is also a view that AI-driven productivity gains can sustain profit growth and further reduce recession risk, even as headline growth slows. The flip side is valuation. There is a growing concern that elevated U.S. equity multiples, especially after a long bull run, may require a corrective phase, a period of what some call market cleansing where prices and expectations reset. That risk feels most acute in the pockets that have run hardest on AI and growth narratives, even while the fundamental story is still constructive. Importantly, leadership is no longer as narrow as it was earlier in the cycle. The equal-weighted S&P 500 and the Dow have both printed record highs, and small caps, as proxied by the Russell 2000, are benefiting from reduced rate hike fears. Value and dividend-oriented stocks have outpaced pure growth and momentum strategies in the first half, while flows have broadened into financials, industrials, and healthcare. Cyclical areas like industrials, energy, materials, and semiconductors are seen as well-positioned for strong nominal GDP growth and still look attractive relative to the broader index. At the same time, There is a clear rotation into defensive sectors such as healthcare and utilities, which have outperformed recently as some technology names lag. That coexistence of cyclicals and defensives at the top of the leaderboard speaks to a market that is optimistic on growth, but also hedging tail risks. From a top-down perspective, the regime still looks risk-on. Both institutional and retail investors are described as being driven more by recent strong returns and wealth gains than by fear, and M&A activity has been robust, with around $2.8 trillion in deals announced this year. Equity indices have delivered solid gains into quarter end, while the volatility index has drifted back toward the mid-teens, even as many expect the Fed's reduced guidance to inject more volatility into the months ahead. The key question now is whether this broadened leadership can survive a valuation reset in crowded growth and AI trades. The most powerful structural force in today's equity market remains the AI investment cycle. AI-driven capital expenditure is fueling U.S. growth, with large data center and infrastructure projects creating a cascade of demand that climbs through equipment makers, industrial suppliers, and local services. SoftBank's new AI data center venture, targeting 10 gigawatts of capacity by 2030 and aiming to potentially triple or quadruple its telecom unit's operating income, is one of several examples of just how aggressive these plans have become. Yet we are now seeing early signs that market enthusiasm for AI infrastructure is colliding with concerns about overcapacity. Implementation of many announced projects is lagging, in part because energy and materials constraints limit how fast data centers can actually be built. At the same time, investors worry that spending on GPUs, memory, and data center hardware may have run ahead of actual end-user demand, inviting comparisons to past fiber buildouts where capital went in faster than revenues came out. That tension is showing up most clearly in semiconductors. The chip sector has dropped about 13% in just 2 days and is on track for its worst single day since April 2025, with South Korean semiconductor names hit particularly hard. SK Hynix has fallen around 14%, dragging the Kospi lower by more than 8%, while weakness in names like Micron and SanDisk reflects worries about pricing, oversupply, and possible shifts in demand as customers such as Anthropic explore designing their own AI chips with Samsung. Market structure is making these moves more violent. A leveraged ETF tracking SK Hynix has ballooned to about $13 billion in assets since October and can account for up to 60% of the stock's turnover on volatile days, meaning mechanical rebalancing flows amplify both rallies and sell-offs. Banks that provide equity swaps and hedges around this ETF face rising costs and capacity constraints, while widespread use of short-dated options in tech adds another layer of reflexivity to price action. Within big tech, strategies are evolving as the AI landscape shifts. Meta is reportedly planning to monetize excess AI infrastructure by leasing compute and models to third parties, potentially creating a high-margin revenue stream but also signaling that its own AI products may not be consuming all of its data center capacity. The stock has seen both a sharp rally on prospects of this cloud AI business and a notable pullback amid internal concerns about slow progress on AI agents and an underwhelming 2026 reorganization. Other hyperscalers are facing similar pressures. Market patience with massive AI Capex at Microsoft and Amazon is wearing thinner, increasing demands for evidence of strong returns on these investments. Enterprises are pushing back on the cost of proprietary models, increasingly favoring open-source alternatives and orchestration tools that let them switch providers, an area where Microsoft's Copilot platform is seen as well-positioned. Major providers like OpenAI and Anthropic are being nudged toward lower API prices and more flexible offerings, and recent cuts by OpenAI hint at a disinflationary trend in AI service pricing that could squeeze margins over time. The AI theme is also bleeding into geopolitics and regulation. Apple's efforts to secure diversified memory supply, including talks with Chinese firms on the Pentagon blacklist, highlight both persistent global memory shortages and the extent to which tech leaders are willing to push into politically sensitive territory to secure inputs. At the same time, voter pushback against data center expansion is leading to state-level moratoriums and tougher contract conditions, even as the federal government continues to support AI and data center buildouts with incentives that may be increasingly tied to grid modernization and long-term commitments. So while regulatory oversight of advanced AI models remains largely voluntary for now, the political and social risk premium around AI infrastructure is clearly rising. Stepping back from equities, credit markets remain a critical part of the story. Investment-grade corporate bond supply is up about 30% year-to-date, yet spreads have stayed tight, around 75 basis points over treasuries, with all-in yields near 6%. That combination tells us that demand for high-quality corporate risk remains robust, even as many see limited compensation for moving down the quality spectrum. There are, however, clear signs of differentiation. Flows have been shifting toward high-quality government bonds and cash, reflecting attractive risk-free yields and a desire for stability as cracks emerge in parts of the credit market. High-yield spreads are described as unusually tight, prompting a much more selective approach to lower-quality credit and a focus on front-end exposure and defensive sectors such as healthcare, banks, and utilities for carry. The greatest stress is in private credit. Private credit funds have seen a notable rise in redemption requests, especially from private wealth channels less familiar with liquidity constraints, with some vehicles blocking up to 2/3 of withdrawals. Blue Owl's flagship funds reportedly faced the industry's largest redemption request and had to cap redemptions again, even as the stock rebounded nearly 7%, highlighting both liquidity pressure and investor willingness to look through it for now. The concern is that the secondary market for private credit is not deep enough to absorb large outflows. Rapid capital inflows into the asset class in recent years encouraged looser underwriting and performance issues at some managers, and the unwinding of those excesses may take months or years, with reputational damage along the way. For listed equities, this dynamic matters for alternative asset managers, leveraged borrowers, and the banks and insurers that have provided financing to the space. On the equity micro side, there are several notable signals beyond AI and chips. Tesla reported second quarter deliveries of 480,000 vehicles, about 25% higher year-on-year and roughly 80,000 above consensus, but the stock sold off sharply as investors questioned the durability of that growth and whether earlier optimism had already been priced in. By contrast, Rivian raised its annual sales outlook and highlighted a new SUV as central to reaching profitability, sending its shares more than 8% higher and improving sentiment toward the electric vehicle space. Elsewhere, Genuine Auto Parts surged nearly 14% on talk of a potential cash acquisition by O'Reilly Automotive, and Palantir gained support from an analyst upgrade linked to easing regulatory concerns, underscoring how idiosyncratic news can still drive large moves even in a macro-dominated tape. Finally, policy innovation is quietly reshaping long-term equity demand. The Invest America Trump Accounts program aims to give every newborn in the U.S. a $1,000 S&P 500 investment account, backed by substantial commitments from companies like Micron, Goldman Sachs, and Morgan Stanley. The initiative, designed as a scalable direct philanthropy model, could entrench equity culture further over time. It sits alongside a broader trend of intensifying U.S. industrial policy, with government incentives and, in some cases, direct or quasi-direct stakes in sectors such as AI, semiconductors, and biotech, which supports Capex but raises questions about transparency and the long-run rules of the game. Pulling this together, equities are trading against a backdrop of slower but still positive growth, a labor market that is cooling without breaking, and inflation that is sticky in services but contained enough to keep the Fed broadly on hold. At the index level, strong earnings, resilient margins, and a broadening rally into cyclicals, small caps, and defensives are offsetting valuation concerns and pockets of stress. The fault lines are in AI hardware and leveraged tech structures, where the semiconductor sell-off, the outsized role of products tied to SK Hynix, and rising scrutiny of hyperscaler Capex all challenge the idea of a one-way AI trade. In credit and private markets, tight spreads and healthy investment-grade demand contrast with redemption pressure and shallow liquidity in private credit, reinforcing the need to distinguish between robustness and fragility beneath the surface. From here, the key signals for equities will be wage trends and participation in upcoming labor reports, AI Capex guidance relative to realized demand, and the evolution of liquidity conditions in private credit and derivatives linked to crowded trades. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.